All right, what's it going to take for CVS Health to turn itself around? We know the drugstore space has been in trouble, but this is the drugstore that's done the most to diversify away from its core business. And at the moment, right now, it may not be working. This morning, CVS reported, and while the results were pretty solid, they also cut their full-year earnings forecast for the third time because their managed care business, the old Aetna, is under pressure. Management originally guided for the earnings of at least $8.50 per share at their investor day last December. They cut it at least to $8.30 in February, before cutting it again to at least $7 in May, and now they're saying maybe $6.40 or $6.65. Very hard. But what's the broader plan to turn things around? And we know it can be turned around. So let's go straight to the source with Karen Lynch, the president and CEO of CVS, to find out. Ms. Lynch, welcome back to Mad Money.
Thanks, Jim. Nice to see you. All
right, so Karen, that's a tough litany, we know. We know you're also up to it because you are taking direct charge of the area that a lot of people feel is now causing some problems, which is the healthcare benefits segment. Don't want to get the cart before the horse, but you've solved a lot of the problems so far, even since we talked to you in January. But now this one's popped up.
Yeah, Jim, let's just take a step back. I think you have to look at the totality of the business. You know, many of our businesses are performing well. Our retail business, our pharmacy business, performing well. We have the best market share that we've ever had. And our Caremark business, our PBM, doing well, had a very solid performance in the quarter. Our problem, as you said, is the Aetna business. We've had some challenges. The industry has had some challenges. And as I said this morning, I wasn't happy with the financial performance of that business. So I'm taking direct ownership and am going to focus on the financial and operational execution of that business.
Well, it's tough because there was a time when you were not highly, your Aetna wasn't rated enough. They weren't giving enough to customers. And then you went the other way and you gave a lot to customers. You became the favored plan. How do you balance these things? Because to me, it takes a wizard to do it.
Well, I think you have to really, it's all about focus and discipline. And I feel really good about our Medicare pricing for 2025. We took an enterprise-wide approach. We brought all of our resources to bear. And we feel really good about where we're headed for our pricing for 2025. And we expect to recover margins of 1 to 2 basis points next year.
Now, when this whole idea was put together, some of it was defense. They felt like, look, you want to use the bricks and mortars, got to use them for more than just Amazon carry-on, so to speak. Make it so that you can use it as an entry to bigger healthcare situations. Now, Oak Street Health and Signify seem to be working. You're absolutely right that when it comes to where we get our shots, we know to go to CVS. Of the stores that are still that you kept open, you say they're almost all profitable. So, I mean, if this piece fell into place, this healthcare benefits, could you have the leverage model to get $8 in earnings or more?
Our goal, we have really strong momentum going into 2025. You said it. Our pharmacy business is performing well. Our Oak Street business is performing as expected. Signify had a record number of home visits, and we expect to see positive momentum through our Medicare pricing, we've had really good success in our national accounts in Caremark and Aetna. We introduced a productivity initiative today as well. So we're pleased about where we think 2025 will land.
Okay, now, on April 30th, Walmart decided to close its Walmart Healthcare Services division. There were 51 clinics. They tried it for 5 years. They even had 4,600 pharmacies. They said they could not make it work. Reimbursement environment and escalating operating costs create a lack of profitability that makes the care business unsustainable. How do you feel about what they did and your model versus theirs that makes it so that you can do it? Even though Walmart's got the best balance sheet in the industry, they had to drop out.
Well, think about this. We have an intentional strategy to give consumers what they want. They want clear access, they want affordability, and they want low cost. And so what we've done with Oak Street is really focused on Medicare members who have chronic conditions. It is a very targeted strategy to support the Medicare population. We have an insurance business where we have Medicare members. So we are having good success. We have tripled the number of Aetna members in our Oak Street clinics since we've had Oak Street. And I think, if you look at our strategy, it's the right strategy at the right time.
Okay, so the stores that are left, are they bringing in more than just customers, so to speak? Because we do know that, say, when Amazon does its Amazon Prime, they're really in some ways targeting CVS and Walgreens. I mean, are you able to withstand an online company that is incredibly low cost and withstand them because of all these ancillary things that you bring in? The bricks and mortar strategy is working with you.
The bricks and mortar strategy is working with us. We actually have said that we have to be in the community to provide pharmacy benefits, to provide immunizations. We talked about that before the show. And what we've been doing is changing some of the formats to include Oak Street and a pharmacy, and we're starting to see traction there as well.
Okay, now the New York Times just penned a story about zombie pharmacies. This is a problem that they said is all over the country, particularly acute in New York, and they mentioned CVS. They say that when you are trying to get out of them, that you still have to pay the lease because the leases are so high that the landlord doesn't want to bother to release. They want to make it so that you pay. Is this a problem, or are you almost out of that of the zombie store business, and all your places are relevant?
I think, we have had a very clear strategy over the course of the last 3 years to reduce the 900 stores. We've reduced those 900 stores. We've have 851. We have a couple left, and we feel confident in our strategy about the number of stores we have.
Okay, in January, you told me that you were piloting the idea that maybe self-checkout was where Pilferage was, and you were trying to figure out whether to scale it back. Where is Pilferage, and how have you done with self-checkout?
It is a great question. We still are seeing theft. It is still challenging us. We've seen less of it, but you'll be happy to know that we are introducing new technology for loyal customers like you. We're piloting in New York stores where if you are a CVS Health customer, you'll be able to use your phone and a QR code, and then you'll be able to unlock the lock that's locking up.
I don't have to press a button?
No, you'll be able to unlock it with a QR code. We have actually a couple stores in New York that we're piloting it right now, so maybe a store near here.
That's brilliant. That's the secret.
We're very excited about technology.
You got the idea.
Yeah.
Well, that's fabulous.
We just have to fix the theft, but...
All right. Now, we have an election coming up. I mean, how much do you have to sit there and parse through what people are saying, each presidential candidate? And how much of it is really state versus federal that you have to worry about?
Well, I think the way you have to think about it is we're in the healthcare business, and we're here to serve healthcare and meet the needs of the demand of consumers and their healthcare needs. It doesn't matter who's in office. Healthcare is personal, and that's what we're trying to achieve. Lower cost, affordability, and quality of health care. That matters to consumers, and it doesn't matter what the election bears. That's our objective, that's our goal, and that's our strategy.
Okay, one last thought. It's a thought. I know it's not what you want, but it's the way that you want to value things. I look at your company, and I think the sum of the parts of this darn thing is so much more than what it's selling for. At the same time, though, that's not the goal, is to break the company up, is it?
We have an integrated strategy, and that strategy is working. We're seeing traction across all parts of the strategy. And as you might imagine, we always look at our strategy and we evaluate it in the terms of our long-term shareholders.
But if you had unlimited capital, would you put it behind the brick and mortar? Would you put it behind Oak Street? Would you put it behind Signify or Aetna? Where would the chips go?
The chips right now would go into fixing healthcare, fixing the Aetna business. Obviously, that's where my focus is because the other parts of the business are performing well.
Will you look me in the eye and tell me that you can do a better job? I know you made a replacement. I know how hard that is. I've had to do it myself. That you can deliver on the Aetna portion. Because if you can, you know you're going to have a lot more than $8.
Yeah, my commitment is I know this business. I know it well. I know where the opportunities are. I know where the issues are. And I am very focused on it right now.
Well, if anybody's going to do it, it's going to be you.
Thanks, Jim.
Okay. That's Karen Lynch, President and CEO of CVS Health. We all go there. It's our pharmacy. Maybe it's the Aetna hidden piece that's holding it back that can change. Mad Money's back into the break.
Coming up, the stock with a can-do attitude, taking the temperature of Celsius. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.